Yeah, thanks, Peter, and thanks, everybody. So yeah, things very interesting times. I want to talk about just the macroeconomic outlook, just a few slides here, and some mega trends within chemicals. So certainly, yeah, it's been a year of real economic and geopolitical uncertainty, volatility. There, you did have that geopolitical turmoil as well as U.S. political uncertainty with the elections. It certainly was one of the factors dampening demand. We've heard this from earnings calls as well as talking to executives. It was just one of the factors happening. But at least some good news is that the central banks, at least you have this kind of coordinated rate cut cycle taking place. So of course the Fed started out with a bang, 50 basis point cut. They cut yet again, another quarter point, and really shifted the focus from inflation to the labor market. So yeah, they're pretty much equally focused on those parts of their dual mandate. Before they were laser focused on inflation, as they should have been. That's come down, moderated a bit, but you got to be careful. Inflation is certainly not dead, and we've seen CPI came out today. It's the core CPI is at 3.3%. Year over year, that is unchanged from the prior month and actually up from 3.2% back in August. So if you look at past 3 or 4 months, not only the CPI, but the core PCE price index, the Fed's preferred measure, you've seen no real progress on disinflation for the past several months. So that is concerning. You saw the 10-year Treasury yields, they're at about 4.4%. They have gone up, and that's a real headwind for housing, residential building and construction. But yeah, the Fed cut, at least they're committed to it so far. They're going to be data dependent. It gives other central banks room to cut as well without impacting their currencies. China stimulus, that was a big, exciting event temporarily, and then yeah, I think some of that initial enthusiasm has died down, and now just waiting for additional details and moves from China. Fiscal stimulus is also planned, but still more details are needed. And there's been a bit of disappointment in terms of the magnitude of those cuts. European Central Bank, yes, they've cut several times, and they're going to continue to cut rates. It'll take several quarters for this to work its way through the system. Talking about 2 or 3 quarters before you really see the impact. But that 10-year yield, that is proving problematic and a headwind. So when we talk to chemical executives, we've been on the earnings calls for Q3. It's still low volume, so that's a number one issue in the chemicals and plastics sector. There was initial optimism earlier this year that you'd see that second half recovery. Very obvious that it's not happening. Even Q4, that's going to be weaker than most anticipated as well. Weakness in building and construction, do-it-yourself coatings, consumer durables. Automotive is weakening, so automotive is clearly weakening in Q4, US and Europe in particular. Number of auto companies curtailing production there. Packaging has been resilient, so that's one somewhat bright spot. Packaging has been resilient. If you look at it, I know it's very text heavy, but the upper right, it's a quote from a large chemical industry CEO, just not on the record, not for attribution, but just that in general, there's plenty of supply, really low demand. And in some sectors, demand is about as low as we saw at the start of COVID. That's pretty stunning. Likely talking about certain durables markets. Another private equity guy who's on the board of 3 specialty chemical companies. He says right now it's all about volume. That's the number one issue. That's also been hindering M&A as well. The leading indicator for manufacturing, this is the Manufacturing Purchasing Managers Index. Anything above 50 is expansion, anything below is contraction. And certainly this confirms no recovery yet. We don't think we're going to see any kind of recovery in manufacturing or industrial until you see these go into positive territory and stay there. US been pretty unusual. There's been a manufacturing or industrial recession for about 2 years. 23 out of 24 months, US manufacturing PMI has been in contraction. We did get one spike up in expansion in March, and there was some initial optimism that here comes a recovery, manufacturing recovery, maybe happening. Just really disappointing since then. I think 7 consecutive months of contraction. China's been really shaky. That was positive for a while. It's back in slight expansion in October, but it's been difficult. Europe, not unsurprisingly, but it's been the weakest region in contraction for 28 consecutive months. Really no end in sight to their industrial recession. They're facing a number of structural issues. there. So really, it's been the services side of the that's propping up the economy. If you look at the services PMIs, they've done much better. They're in all three are in expansion territory for services. So you have difficult on the manufacturing front. There's no signs yet of any kind of recovery. Some people are hopeful next year, mainly looking to the second half of next year. But now just want to shift to some mega trends, just overall big trends driving demand for chemicals, and one or even supply as well. The first one is really big oil. So big oil, Middle East big oil in particular, they're shifting away from fuels. They see fuel demand peaking, plateauing, declining eventually from the energy transition. So they want to put more of their oil into chemicals, which is still going to grow at a GDP plus rate. So there's still growth while fuels demand, they fully expect this to decline. So they're putting a lot more CapEx into these chemical projects, plastics and chemicals. That's just going to intensify global competition for chemicals. Decarbonization, circularity, even in difficult times, customers are still striving to meet some of their targets on emissions reduction, use of recycled or bio-based packaging, and companies are making big investments. The biggest one is Dow's net zero carbon cracker, where they capture the CO2, put that into an existing trunk line, the Alberta trunk line, and they're going to sell what they're going to call zero carbon polyethylene, and hopefully sell that at a premium. LyondellBasell is a company that they're putting about a third of their CapEx into plastics recycling and some bio-based as well. They want to capture about 20% market share in North America and Europe for recycled plastics. Third mega trend is reshoring and nearshoring. I think this is going to be the trend for this decade. Essentially, manufacturing supply chains moving away from China, closer to home. You do have the massive U.S. stimulus, still the Inflation Reduction Act, the CHIPS Act for semiconductors, and the bipartisan infrastructure law, all driving that, plus tariffs as well. Essentially, new factories are being constructed. It's in automotive, battery, appliances, chip fabs, and even data centers for AI data centers. Eventually, that is going to drive chemicals demand going forward in the long term. Here we see capacity. We talked about intensified competition, not just from the Middle East, but from China, and still by 2027, you see record levels of ethylene capacity additions for that year coming on. Propylene as well, a little less for paraxylene, but these are the three building block chemicals. Still pretty, even today where we have major overcapacity, there's more coming on, unfortunately. Yeah, getting towards the end, but this is kind of to conceptualize this or visualize what's happening in terms of competition intensifying. So we talked about Middle East big oil, putting more of their CapEx into chemicals and plastics rather than fuels. They're building not just in the Middle East, but also elsewhere in the world. ICIS, we're estimating about 7 million tons by 2028 that they're building for ethylene capacity in the Middle East, but also an additional 7 million tons elsewhere, a lot in Asia, but also the US with Qatar Energy. You do have so we also have Chinese state-owned oil companies, state-owned enterprises. They're continuing to build capacity, still continuing to build. And again, this is not necessarily profit-driven, but for self-sufficiency, strategic reasons. Profit margins are secondary. They're willing to accept much lower profit margins or even operate at a loss, still putting capacity through. So really competitive. The U.S. shale gas players, they can compete. U.S. crackers, among the most competitive in the world. U.S. exports almost 50% of the polyethylene they produce. Really cheap gas. Yeah, pellets. Okay. Yeah, in the form of pellets. Someone said. So who's getting squeezed is really the high-cost commodity chemical players. You can't compete. Competitors in Europe, Japan, South Korea, Brazil, you can't compete in commodities. So what you're seeing is a major restructuring taking place. Number of assets under review, a growing number of assets under review for sale, for shutdown, restructuring. Companies are pivoting their business models more towards specialties, using innovation, green, and low carbon chemicals. So that's really, everyone says, innovation is critical, of course, but you're really, for some of the European players in particular, you're really kind of backed into that corner. That's all you have, really. You don't have any kind of cost advantage. Okay, just a quick pop quiz for anyone. So, the US and China had a trade war, started in the first Trump administration in 2018. So since that trade war, what have US ethylene and derivatives, we're looking at polyethylene, ethylene glycol, what have they done since that trade war? Since that trade war started in 2018, so we're talking about, 2017 to the last full year of 2023. But did they go down 50%? Were they flat? Up 50 to 100? 100 to 200, 400 to 500? Anyone can take a guess. There's no prize, so there's no pressure.
Take a vote. Take a vote.
Who thinks it's A, down 50%? B, flat? C, up 50 to 100%? D, 100 to 200? We had 50 to 100 here, right? Okay. E, 200 to 300? Okay, and F, 400 to 500. All right. Answer is F. So this has gone up 4 times since 2017, before the US trade war. US ethylene and derivatives exports, we exclude PVC here, but it's really all 3 grades of polyethylene as well as ethylene itself. It's up almost 5 times actually, to 4 million tons for 2023. The trend continues this year as well. What happened was there was a trade deal struck in 2019, December 2019, where some tariffs were taken down. They were removed, others were reduced. But by February 2020, China actually offered its importers waivers on a number of tariffs to allow them to go to pre-trade war levels. And since then, you did have a decline during the pandemic, but since then, the US exports have really skyrocketed. So this is relevant because, of course, you do have the second Trump administration coming up, and these proposed baseline tariffs, 10 to 20% for all imports, threaten 60% tariffs on Chinese imports. Of course, it could be a negotiating tactic, campaign rhetoric. Clearly, things are going to change, but if you get any kind of level close to that, you're exposing yourself for retaliatory tariffs that could take place. And the U.S. chemical industry, it's not just ethylene chain, but the chemical industry itself. We looked at, I think it's about 70 chemicals that ICIS covers. It's about a 45% increase in U.S. exports to China during this period, and also not just on an absolute basis, but as a percentage of total U.S. exports, China makes up a greater percentage. So thanks so much. We do have a page called Macroeconomics and Impact on Chemicals with some more economic indicators and forecasts for you. That's available to all subscribers to ICIS. Okay, thanks so much. And come over for
Come on
for
here,
some.
and we're going to just steal this microphone. If you look at the picture, there are a lot of things to be concerned about. Are you overall optimistic, pessimistic, neutral about the next 5 years in the chemical industry, given all the myriad set of things that you talked about in the slide?
Well, clearly, Peter, I think there's going to be winners and losers here. Through, the industry is going through such a fundamental shift with this increase in competitiveness that companies just have to figure out what to do, where they want to spend their investment dollars, their research dollars, and kind of realize where if you don't have a particular advantage in an area, you do have to shift strategy rather quickly. And this is not just a normal cycle where, okay, we're just waiting for the upturn, and this, you're simply waiting for that to happen. Some things have structurally changed. You see some of the mega trends with the Middle East guys being more aggressive in commodities, plastics, and they want to get into specialties as well. But you really have to think about that and potentially change strategy. But overall, it's good. At least in the near term, you do have these rate cuts. I think these rate cuts will happen. These will start to work their way into the system. To 2025 itself, there is a much better chance that you'll see somewhat of a rebound there. We just haven't seen indications yet.
My personal view is, if you take a really big picture look, is you've got a couple of things that are really a challenge. One is weak economies, particularly Europe and so forth, and China slowing down. And there'll be some people who are experts who will talk about that issue a little later on. I personally think that China's economy is really struggling structurally to grow, and will have the current stimulus packages that they put in place. I don't think that'll be enough to solve your debt problem and so forth. But at the other side of not just, growth. It's a supply issue. I think the most troubling thing is Chinese capacity and Middle East capacity, right? Because neither one, in the case of Middle East, at least they're low cost in oil, et cetera. But they're adding capacity that's not necessarily justified by demand. And the Chinese are not really competitive, in terms of their cost position. They just want to, add capacity. And, one of the problems with the Chinese business is they're willing to lose lots of money, right? I mean, so they said, there's only one thing that's worse than a very, very strong competitor's low cost. It's someone who's willing to lose money for a long period of time. And remember, these are all state-owned, companies, the big, chemical ones. And that combination is very difficult. So my own view is it's going to be very challenging on the supply demand. I know there's an unnatural additional of supply and a very weak demand, particularly Europe. I think Europe is going to be a challenging area.
Yeah, sure. And at least on the one positive is that you are seeing actual announcements for shutdowns. Yeah, shutdowns for ethylene capacity, polyethylene. We saw Versalis, Italy-based Versalis, it's an arm of NEV, energy company in Italy. Yeah, shutting down 2 crackers. They are shutting down an LDPE line for polyethylene, as well as looking at another crackers for either sale or a joint venture. ExxonMobil is shutting down capacity as well. So you are seeing these announcements, and then tremendous amount, again, asset review, assets that are getting put under review. Dow's polyurethanes business is under review. LyondellBasell has a number of assets under review. So it is just a growing pile of assets, and hopefully so you get some of these shut down, not necessarily change of ownership. Also, it's a big question of who's going to buy these assets. Yeah, these are largely commodity, low margin assets. It's going to be tough.
Yeah, in fact, the number of announcements of companies particularly reviewing their business in Europe, it's a long list, right? And you haven't mentioned a couple of them, but it's a long list. And then there's some people who are centered there, there's no place to go. I mean, if you're BASF, where do you go if you have so much of your capacity in Europe? And also, you have, the whole giant, facilities in Germany that are all integrated. It's hard to decouple, right? So, and so I think for a lot of people, but, Steve and I will talk about the amazing, but if you can believe it, it's not surprising that the volume of commodity chemical M&A has plunged. There's literally plunged. And there's not a single material commodity chemical M&A deal that happened in Europe in the first 9 months of this year. So not surprisingly, the valuations have come down dramatically. You don't have buyers. You have lots of sellers and you have no buyers. So there's going to be a lot of serious, thinking. But the problem for a lot of these places is that there may not be much of an exit, other than shutting down. What's your view on the China situation? I know we have some China experts coming up who will tell us real story, but what are your experts in ICE saying about what they think is going to happen, in China, particularly in chemicals?
Yeah, thanks, Peter. There's not much optimism. Yeah, we do have a number of folks in Shanghai, some analysts, as well as price reporters, news reporters. Yeah, not a tremendous amount of optimism, but there is some hope. At least, maybe some of these stimulus measures will give, at the margin, have an impact. And you just need consumer confidence and just the folks. But they have so much of their investment in property, even in stocks that have just not performed, and so it's very difficult to get that. Once you lose that confidence in the government's measures, it's very difficult to get that back. So we're just waiting for the data, waiting for the potential turn, but there isn't a hell of a lot of optimism there that things will get materially. You're going to get this big boom this time. Some real structural issues and debt issues that don't simply go away. They already had their big tremendous stimulus after the financial crisis. pumps a tremendous amount of, also those debt fuels. Property boom and commodities boom that already happened, that's not gonna, you're not gonna see a repeat of that's clear.
So you're a bit pessimistic about what's going to happen in China.
But maybe, maybe it's a better year next year, than we had last couple of years. Yeah, there is a chance,
Yeah, I really wonder what, President Xi thinks about Trump being elected. As president, can't be a happy moment, right? Given the threat of terrorists and so forth.
Right, on time.
How about the Middle Eastern guys? I mean, where do you think their mentality is today? There've been a lot of shifts in demand for transportation, fuels, et cetera. Where do you think they're headed?
So yeah, the energy transition or the EV transition in particular, I think that's going slower than many people have anticipated just a couple of years ago, especially in the US. It's continuing in Europe, but still it's slower, also a little bit slower. China's very fast, it's happening quickly in China. But the Middle East players, they do see, they have to, again, put their capex into chemicals and plastics. They'd rather do that. Just an example for Aramco, Saudi Aramco. They want to quadruple the amount of oil they put into chemicals from 1 million barrels a day today to about 4 million barrels by 2030. So they can do this in a couple ways. They can build new capacity, which they're doing in the Middle East and elsewhere. Korea is a big project. I think that comes on in 2026, 27 there with the Shaheen project for S-Oil. That's all, chemicals. And so they can build new capacity, but also they are taking minority stakes in existing Chinese companies, about 10% stakes. And with these equity stakes also come a crude oil supply agreement where they're going to put more of their oil into these existing projects, as well as helping to finance future expansions, believe it or not, in China, because you need the capacity.
Yeah, actually, you make a good point because a lot of people, when they talk about the Middle East players, they keep thinking about expansions in the Middle East, but a lot of them they're doing joint ventures with Asian companies in India and China and so forth. I think in part perceiving that that's where a lot of the long-term growth would be. Right? But still, they can ship their oil over there. So, it doesn't mean that they can't get advantage in terms of their, selling their oil. Right? Any sense though about, this election here, you talked about in the United States, that you talk about tariffs and things like that. Any other speculation about what some of the Trump policies that may or may not be the ones you talked about during the re-election campaign, what they're going to be and therefore what impact they have? I mean, there's a lot talking about deregulation, for example, and also drill, go baby drill, but then there's tariffs, which then creates problems for people trying to buy raw materials. They're buying a lot of raw materials from China. So, what's your sense of what actually might go through and what the impact would be?
Yeah, where to begin? But I'll just mention that for tariffs, at least the president does have a lot of power there. They don't need approval from Congress or anybody. The president can unilaterally just make these changes to tariff policy. Also, so if you look at what Trump has talked about, it's really, where are we going to see the changes? It's really tax, in terms of lower tax for corporations, individuals. It is regulations, yes, less regulations, and the chemical industry is certainly optimistic on that. The permitting process, that they've been talking about this in particular, the American Chemistry Council. So it's really that energy policy as well, that yes, they want to boost energy production and also build out some infrastructure as well. There you go, LNG exports, no restrictions there. But it doesn't not necessarily positive for crude oil if you have more supply coming on. There is a great deal of there's optimism in the business community, and you see the stock market at record highs. Certainly, you do see that potential optimism. I think Trump, he's going to be one of the most powerful presidents really in memory, just because you do have. It looks like you're going to have both houses of Congress. It hasn't been called yet, the House races, but okay, you've got the Senate, you could have the House, you have your handpicked Supreme Court folks over there. So you have pretty much everything, and it's very different from the previous Trump administration, where I think a number of folks wanted to control Trump. Okay, let's see, we know bit better, let's just control this guy. Yeah, a lot of those people have been kicked out of the party or just, now they're all in, I think it's pretty much the Republican Party is Trump's party, so. Those policies are gonna be much easier to push through in terms of, yeah, tax regulations and so forth, and tariffs, certainly, yeah, you don't even need congressional approval for that. So, yeah, so it'll be a very busy 4 years at least, and a pretty, at least from a journalistic standpoint, and it's like, oh, wow, it's gonna be a lot to cover. And yeah, it can be exciting, it can be tiring as well, looking at this, but at least, yeah, you do have a sense of what could happen, and it's much more likely because you have especially if you have the House, you have both houses of Congress as well. And the Supreme Court.
Of course, we also have Elon Musk, who's going to be the head of the Department of Efficiency, which currently has 0 employees and is not an official entity. So he's probably really excited about that appointment, right? By the way, I'm going to take a 2-minute pause break by just saying, last night I said, when I sit down and just list the disruptions that I can think of, right? Because my perception was that we had an unusually large number of disruptions. So I'm just going to read my list of the things that came to mind last night when I did vote my, just to give you some sense of how many there are, but also what the dimensions are. So first category, geopolitical and political. 1, wars in the Middle East and Ukraine. 2, change in military and technology to drones and cyber warfare and away from naval ships and tanks. 3, potential conflicts in South China Seas and potentially related to Taiwan. 4, global climate agreements, treaties, and changes in policies and issues that we haven't talked about, but let's see what Trump does with the Paris Accords, right? 5, Chinese deflation and export of products due to excess capacity, which we've been talking about. 6, shifting political landscape in many countries, particularly in the US and Europe. There's been a dramatic, it's everywhere, right? I mean, we're talking at my table, there were people from Canada said, so whether it's Japan or China or Canada or Europe and so forth, US is not the only place where there's been some big political shifts. 7, Trump re-election and all the things that might come with it, whether it's tariffs, immigration, regulatory, climate change. 8, political landscape in China and Xi's policies and legacy requirements. Legacy requirement is one important issue because he said, by the time I'm done with my 3rd term, Taiwan will be part of China. Well, the clock is ticking. 9, shifting alignments of Russia, Iran, China, and North America. Or who's buddy with who. Next group, economics, slowing economic growth in China and Europe. 2, potential economic crisis in China that we talked about. 3, the threat of increase in tariffs by the Trump administration. 4, supply chain challenges that are shifting. 5, persistence of inflation. 6, interest rates. 7, tax laws, and including the possible collapse of the global corporate tax rate initiative that had been, had been moving along. And 8, the impact of AI on a wide variety of industries and on labor. And last, a list of 7 things for the chemical industry from a structural point of view. Excess capacity, commodity chemicals escalated by Chinese and Middle East non-economic capacity additions. 2, shifting demand for chemicals geographically. 3, increasing regulatory pressures in certain countries, including such things as single-use plastic. 4, net zero and other sustainability pressures. 5, green chemistry, recycling, biomass chemicals. 6, serious deterioration of European chemical industry economics that we talked about. And 4, the impact of AI on industry, manufacturing, R&D, organizational structures and costs. So those are the ones that just happened to come to mind last night when I was on my computer. But these are all fairly significant. There's nothing minor. And I think when I finished writing the list, which was not everything that I could think of, it did suggest 2 things. One is we do have an unusually long list of uncertainties in major categories, whether it's economic, geopolitical, political, or things specific. Which just means it's going to be harder for those of you running chemical businesses to figure out even what the baseline is, right? I mean, a lot of the CEOs I know, they say, I'm having trouble creating a base case forecast, right, for the business, because I don't know which of these scenarios is going to be true. Now, did I leave anything out, Joe?
No, but hope you got a good night's sleep.
No, I had an enormous headache after I wrote this list. But any of those that you like it, because I covered a lot of things more than just the things we just talked about, that you want to point out.
No, I think just the geopolitical landscape and yeah, the wars are yeah, that, you know, kind of overrides everything. Where, yeah, this could, you know, any kind of major escalation and of course, nuclear threat that could, if that comes to the fore, we, yeah, hey, business conditions, overcapacity, that's not so much of a great in relation to that. Yeah, so that is a, yeah, that's obviously a huge concern for business and everything.
Yeah, that's right. Do you, you know, AI is a hot topic these days, right? Do you have any opinions about whether AI is going to have an impact on the chemical industry in the future?
Well, I think the chemical industry has been very slow in terms of adopting new technologies, and everyone's trying to figure out how this is going to fit in. Maybe in terms of discovering new molecules, this could help. It could help in other processes. But I think also if you look at the build out of AI data centers and some of the cooling technologies that are being developed to help cool these or data centers, make them more energy efficient, that could have an impact for a certain when the chemicals demand, as well as just the energy requirement. I think the energy requirements for these data centers, yeah, tremendous. So you're going to have to continue to build out. Just want to make sure, of course, chemical industry and Peter Huntsman has pointed this out, as well as Dow CEO Jim Fitterling, that hey, look, yeah, we rely on cheap power, electricity, energy here, and yeah, AI data centers, that's going to soak up a lot of it. Yeah, we have to come to some better solutions for this, or else you are going to have an energy crunch. And in fact, we're seeing nuclear. Some of these data center, hyperscalers teaming up with energy companies to build out nuclear capacity or restart new reactors. You also have small modular reactors, SMRs, that are being developed. Maybe it takes about a decade, but there's some promise there that these small modular reactors will help provide the power needed. But yeah, that's a concern for the chemical sector as well, just to maintain their competitiveness.
My own view, I've had a lot of discussions with people who are leaders in AI the last couple of months, and we've done a bunch of analysis. So we looked at whether AI is a tool or not a tool, or an opportunity in this bank strategy. So I think for the chemical industry, I would say that it's less. There'll be some normal stuff about maybe how some of the back office types of things, labor intensive, you might be able to do some cost. But last time I checked, there's not a lot of people in the chemical plant, so it's not like you're going to say, well, I'm going to take AI and get rid of the operator, right? That's going to be tough. But I do think from an operational, point of view, there'll be opportunities. I think the big issues are the indirect ones, what you're saying. So, for example, this huge consumption of electricity will have an indirect effect, right, on the chemical industry. By the way, my own personal view about AI is that we're in a bubble, and that the people, go back through nanomaterial survey, DNA, everybody gets overly excited, and there's some portion that's real and some portion that's just a bubble. And let me explain to you why I think most of AI is a bubble. One, AI doesn't do a good job if the data is not pristine. It just makes things up. It will also mix things up, but also it's only as good as the data that's in there. It works better if the data that it's operating on is pristine, so forth. So for those companies or that have their own data set that they know is pristine, applying AI methodology to that, if there's a value-added application, might work. But for the broad thing, it just makes stuff up, right? I ran my wife's name through, ChatGPT, and half the stuff they put in there was totally made up. And I called her and I said, congratulations, you didn't graduate from Columbia, you graduated from Princeton. That's according to ChatGPT. She said, really? Where's my diploma, right? So that's that. But I think the other problem with AI is economic. So you know, there's someone said, if you give things away for free, people will use it. But if they actually have to pay the real cost of the product, it may turn out to be different. And the disconnect is, you read all these stories about how Microsoft holders are spending billions of dollars on data centers, et cetera, billions of dollars. The top four guys, Microsoft and Amazon, support, are going to spend $250 billion in 2024 on AI data centers, et cetera. Now, if you say, what kind of return do you need on that? And how much money can you make when you charge $30 a month for unlimited use? And the math, you can't make the math. So I think basically, fundamentally, the economics of AI for most non-value added applications will be suspect. Where AI is going to succeed, which is a relatively small part, is where it's a very high valued application and where the data, you can control the data is pristine, right? We took a hard look at Young Partners about whether we could use AI. And we concluded not, because we have pristine data, but it's not data we want to share with them, right? If we wanted to share with people, we could put ChatGPT on top of our data, which we have fantastic data going back years. But then you know, it wouldn't work because we'd be sharing with other people, right? So we concluded it didn't make sense, right? So it's going to be very, very interesting. AI will change things, but it may not change things as much as people think. But I also think there are going to be a whole lot of people who lose a lot of money because they bought shares in an AI company at, you know, a $20 billion valuation, and you know, and it's not going to work, right? I mean, do you have similar feelings?
Well, maybe I can even pitch our chatbot. So we have.
Oh,
as an idea.
Exception devices, chatbots, of course, it's one.
Right, we haven't really monetized that anymore, but this is, you know, it does use our, again, C data, it is, you know, ITA, the story, you can ask it, questions for what is our starting forecast for the US for the next 3 years, things like that, and just, you know, for customers to be able to retrieve the information faster, so I think it's, you know, as long as, yeah, it depends on the data, though, depends on what data it's looking at, so yeah, this can be a helpful tool, save a lot of time. But yeah, you have to be careful. Yeah, be very careful knowing where that data comes from.
So we have some time for some questions before our next panel.